Well, unless you've been under a rock the last few years, you know why the Federal Reserve is doing what they're doing. Why? Well, to cure inflation. Okay. So one of the biggest pieces of the inflation part, or the number that we see on a daily basis, is in shelter. Okay. There's big news out today. And I don't know if this is going to slide under the radar with a lot of people, but I wanted to bring it to your attention because there's really not a lot of economic news today. But this piece of the puzzle might solve the riddle on the Federal Reserve getting us to 2%. So let's get over to it. I want you to see an interview this morning with CNBC, this young man, and then I'm going to break it down and I'm going to show you all the factual numbers, where I got this content. And then we're going to do a chat GPT to figure out, okay, where would the inflation numbers be if these new, basically rent equivalent numbers come in. So if you're confused, don't be. I'm going to tie all this together here in 1 second. Economic calendar right now is basically virtually nothing. Friday, you can see the manufacturing numbers went from 51 to 51 and 54 to 55. Nothing there to write home about. The existing home sales were right on point, so they're getting a lot better with this. But here's the interview I want you guys to see, and then we're going to tie this together to kind of show you guys why I think the inflation numbers are going to get to 2%. Fairly quick. So without further ado, Becky, take it away. This is a fantastic interview, so treat us good, Becky.
Renters are staying put, leading to price hikes for rent and complicating the overall inflation picture. Joining us right now is Igor Popov, Apartment List Chief Economist.
Hi, Igor.
Igor, good morning. Thank you for being with us.
Morning, Becky. Happy to be here.
Okay, so let's talk a little bit about this situation. We know the housing market has been really difficult. There has not been supply. That means people can't find houses to buy. That means they stay in their apartments. And that means that those rents have gone up because there's so much demand. What are you seeing right now nationwide?
Yeah, absolutely. The rents are up over 20% since the start of 2020. And in general, the rental market has just been on an absolute roller coaster since the start of the pandemic, really. Typical year rents grow maybe 3%, but we saw rent declines in 2020, skyrocketing rents in 2021 as we saw an explosion of housing demand, really tight supply, and then a real cooling housing market coming on the back half of 2022 with rate hikes and cooling consumer confidence. So that brings us to today. So nationally, we're tracking rents to be roughly flat, down a little bit year on year from last May. But it really depends on where.
This is very important. So pay attention to that part. That's what we're going to come back to.
Where you are in the country. We're seeing a lot of regional divergence. So we have some cool markets in the Sun Belt that are actually seeing rent drops. But if you're a renter in the Northeast or the Midwest, you're seeing some pretty strong rent growth this summer. So renters' experience of the housing market and the rental market in particular really depends on where they are right now. And one of the big drivers is really regional differences in construction right now.
Okay, so where there is additional construction, you don't have as much pressure on rent because there is new supply that's coming on?
Yeah, absolutely. That's good news for renters. There is a lot of new supply coming on. So a couple of years ago, when housing demand was booming, interest rates were low, it was a pretty ripe time for developers to get in on new projects. But those projects have taken a while to hit the market. We actually entered the year with 1 million multifamily units under construction, which was a U.S. record. And that's hitting the market now, but it's not evenly distributed. So a place like Austin, Texas is permitting 10 times as much new housing per capita as a metro like Cleveland or Chicago. And that's really driving the differences that we're seeing. Rents in Austin are down 7%. Places like Chicago, Providence, Cleveland, Milwaukee are seeing 3+% rent growth this summer as we enter kind of peak moving and leasing season.
Let's talk about what this means just in terms of the inflation picture, because the CPI looks at rent a little bit differently. How does it measure it?
Right. So there's really two different stories when we look at market rents and the average rents that Americans are paying, which is really how we measure rent for the purposes of tracking inflation. And so market rents move quickly. They can turn on a dime. The rents that average Americans are paying, they move slowly because most folks are locked into 12-month leases. And as a result, the CPI, the rent measurements that factor into the consumer price index, they lag what we see in the market by really over a year. And so CPI rents are really a shadow of market rents. They're still tracking the deceleration that we were seeing last year in rent growth. And so this creates a pretty tough picture for the Federal Reserve, because I think there's a feeling that the housing market has already cooled significantly from rate hikes, but we don't really get the full scorecard until CPI rents catch up to the market. And they're cooling in the CPI, but it's going down very slowly. It's like watching paint dry, and we keep waiting for the CPI rents to come down. They're coming down, but very slowly. And what we're seeing now in the market, if we're seeing a new rebound, and I think we're seeing a new rebound in demand across the country, that again is going to factor into CPI rents 4 to 6 quarters down the line.
Okay, so let's take what he was talking about. Let me see if I can go back here and find it real quick, because this was kind of a cool number that if I can find that in there, right through here. So here's where rents were last year. Here's where rents are this year. So basically nothing. So there's a 0% change there. And this is from the national media, and this is from him. He's an economist that does this. Okay, so here's what I want you guys to look at. Let me get my head out of the way. So here's the CPI number. This is the inflation number that the Federal Reserve watches. So not too long ago, the inflation numbers were at 9%. Okay, now we're right down through here, about 3.3%. Okay, what I want you to understand is right through here. Here's the shelter numbers that he was talking about. Every month it comes in, and they say it increases a little bit. He just showed you that it was nationally, it was zero. Okay, so they're factoring in a 5.4 increase in the shelter prices. Okay, so that's the number that's in there right now. So why is this so important? Well, the effective shelter number in the CPI makes up 36% of the number. Okay, so I went to ChatGPT and made this thing up. If you were at 3.3 right now, and I put 40% of it's 36%. So if 36% of the housing numbers were put into this factor, what would this do to the inflation number? And because of the error I made, and I'm not going to redo this right now, it comes at 1.98. So if I change this to 36, this is going to be 2 point something. So we're going to be right at the 2% level that the Federal Reserve is looking for. So are we there? Well, that's where the data is so skewed. And this person says it, and a lot of other people say it, the data is lagging. Okay, so as soon as this data gets kind of more current, you're going to see inflation just basically right at the pivot point of where the Federal Reserve wants it to be. So that's that part, or that's that take of the market. So now let's look over. There's a tool out there. It's called the CME Fed Watch tool to predict what the Federal Reserve is going to do at the next meeting and then further meetings down the road. So right now, what you have to understand, what the Federal Reserve controls is an interest rate that's called the federal funds rate. Okay, why that's important is because it's not your mortgage rate. It's not your car rate. So if you're sitting on the sidelines waiting for the Federal Reserve to lower rates, that's not how it works. You're not going to get a lower car payment or a lower mortgage payment because of that. Usually what happens is those numbers kind of gradually change, up until the Federal Reserve meetings and so forth. But what I want you to understand is right now, the federal funds rate is 5.25 to 5.5. There's a range that's out there, okay? Let's get over to the Fed Watch tool. Oh, I blew it. So let's get over to the Fed Watch tool. It's right through here. You can go to the CME Fed Watch tool, and here's what it tells you. In 40 days, the Federal Reserve is going to come out, and what's this going to tell us? Well, what they're going to do with the federal funds rate. Are they going to change it or not? So let me get my head out of the way because I don't want to be a spoiler alert. So right now, here's what they're saying. Okay, at the next meeting, there's a 89.7% chance that they're not going to do anything because right down through here, this is the federal funds rate currently, 5.25 to 5.5. Now, this has virtually been nothing lately, but now there's a 10% chance that there might be a rate cut, and you can see that. So they would cut from 5.25 to 5.5. to 5 to 5.25. Okay, so now let's get to the probability of what's going to happen over the next few meetings. Now, right through here, this is going to tell us basically what the plans are. Now, just the other day, this was about 60%, so this is changing a little bit, but it's still over a 50% chance at the meeting in September. In November, they're going to cut, and most likely you can see it right through here, 5 to 5.25. All right, and then they're saying next year or the latter part of this year, they're most likely going to cut again. And that probability is kind of all over the map. So we're waiting to see. But most people think they're going to cut one of these and then maybe here or here. So only time's going to tell in that piece of the puzzle. So that's what I wanted to talk to you guys about today is because mortgage rates are flat right now. what's the projection out there over the next, now it's hard to predict, what Monday, Tuesday, Wednesday is going to be. So my goal is to kind of predict, what's coming down the pike. So the next CPI report should be starting to come back down. But the area that scares me there is oil. Oil is the lifeblood of our economy. And oil just rallied from about $74 a barrel to $82 a barrel, and it's still going up. That's a big increase. So that's where a lot of times when you get the inflation numbers, you'll get a number and it's like, whoa. And then you'll get what's called the core number. And what you have to understand with the core number, it strips out food and energy, because just as we're saying, the oil prices have just spiked considerably over the last couple weeks. So that is also playing a role in this. But the good news behind all this is, based on the information we got today from this economist that basically just monitors rental properties and such, it's actually fantastic news when it comes to the inflation front. So here's where mortgage rates are today. These are the top 6 products people use when they're buying their first house. How's the market reaction to any data that we have today, which is virtually nothing? Let's go over to here. We're seeing right now the MBS market is, it's up 2. So I'll say that's flat. So I don't expect anything to happen today. The news is already out for the day. It's summertime. It's hot everywhere. And there's probably most of the people are going to take a half a day off. So I'm expecting just a completely stagnant market. I don't think rates are going to change today. But down the pike, when the inflation numbers start coming out more and more and more, I think you're going to be surprised, and there's going to be some actually really good news in the market here soon. So that's my report for this morning. Please visit me later this afternoon for the closing bell. We can see how I called it. Are rates going to change? Are they going to be completely flat today? And then I might have another surprise for you later this afternoon. So thanks so much for watching, guys. God bless. Have a fantastic day, and I'll see you at the closing bell. Bye-bye.